Can the Aviva Signature Investment Plan Platinum strike the right balance between living in the moment and secure your financial future? Let us find out through an in-depth analysis in this video. Hi, welcome to HolisticInvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. So this is a unit-linked non-participating individual life insurance plan. It provides you with both security, which is sum assured, and growth, which is the fund value to support your family in your absence in case of an unfortunate event like death. Now let us take a look at the key features of this policy. So it provides a dual benefit of the sum assured and the fund value payout in case of the policyholder's unfortunate demise, and there are no premium allocation charge, which ensures more of your premium goes directly into investment. It offers 8 diverse fund options to suit varying risk appetite. It enables easy access to funds through partial withdrawal and systematic partial withdrawal during unforeseen circumstances. It also includes 2 tailored saving strategy to adjust your investment between equity and debt fund based on your preferences and life stage. Now let us take a look at the benefits. So death benefit is something the nominee or the legal heir will get if the policyholder unfortunately passes away during the policy term. So all the 3 options like base sum assured, top up sum assured, fund value, everything will be payable as a death benefit in case of death of the policyholder during the policy term. Also, death benefit shall be at least 105% of the total premiums, which is your both regular premium and top up premium if they had any received up to the date of death. So another benefit is the maturity benefit. In case the policyholder survives till the maturity date of the policy, then the fund value of units pertaining to your regular premium and fund value pertaining to your top up premium, if you had any, will be payable as a maturity benefit. So these are the benefits available under this policy. So the fund options of this policy are balance fund 2, bond fund 2, enhancer fund 2, growth fund 2, infrastructure fund, protector fund 2, PSU fund, mid cap fund, discontinued policy fund. Now all these fund options are categorized based on the percentage of allocation they are given to the respective asset classes like equity, debt, money market and other cash instruments, and also according to the risk profile it has, like it can vary from low to high. Now let us take a look at the charges, like various charges present under this policy. There is something called policy administration charge, which will be made by monthly redemption of units from your policy unit account and is applicable throughout your policy term. And there is also fund management charge for managing your fund, which is 1.35% per annum for all funds other than discontinued policy fund, while the discontinued policy fund would be charged 0.50% per annum. And there is also mortality charge for providing you with life cover. So it will be applied on the sum at risk, which is the difference between the amount of death benefit payable minus your fund value as a deduction of this charge. There are also surrender or discontinuous charge. So this charge will be deducted from the policy unit account in case the policy is discontinued within the first 5 years. It will be based on your annualized premium, fund value and the year you choose to discontinue. There are also switching charges. So the first 4 unit switches within a policy year will be free of charge. On subsequent switches, a fee of 250 rupees per switch transaction will be charged. There are no partial withdrawal or miscellaneous charge and also premium allocation charge. But unlike other market-linked investment options in the market, certain charges persist throughout the policy term in this policy. So these ongoing expenses add to the investor's cost and can gradually diminish your overall returns over time. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are your top-up premiums can be added at any point during the policy term. Partial withdrawals are available after completing 5 policy years or when the policyholder turns 18, whichever comes later. Systematic withdrawals here offer structured regular payout tailored to your financial needs. Premium redirection in this policy allows you to reallocate your future premium across funds without any additional cost. You can enjoy unlimited free fund switches to adapt your investment as needed. The disadvantages are policy loans are not permitted under this plan. No liquidity is provided during the early years of the policy. The sum assured might be inadequate to meet your significant financial needs. Investments are also based on the net premium, which is calculated only after deducting your applicable charges. So, these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us now calculate the internal rate of return IRR based on the benefit illustration they have provided in the policy brochure to help us make an informed decision by what kind of returns we will get in our hands at the end of the day. So let us assume 38-year-old male opts for this policy with a sum assured of 15 lakhs. Both the policy term and the premium payment term are 20 years, requiring an annual premium of 1.5 lakhs. So the fund value at the end of the policy term assumes consistent premium payment. The policy brochure projects potential returns based on assumed investment rate of 4% and 8%. This is just to indicate the worst and best case scenario of this policy. These rate of return are neither guaranteed nor indicative of the actual upper limit or lower limit of returns this policy can give you, because the maturity benefit depends on various factors including the policy's future performance. So at 4% return per annum, the fund value is 35 lakhs, translating to an IRR of 1.45%, which is lower than the interest offered by a basic savings account as per the policy's maturity calculator. So at an 8% return, which is the best case scenario, the fund value grows to 56 lakhs, yielding an IRR of 5.63% as per the policy's maturity calculator, which is still below the interest rate provided by bank fixed deposit. Although this policy is positioned as a long-term investment, its low returns significantly limit wealth creation. Consequently, the accumulated corpus may fall short of meeting financial goals, and the sum assured in this policy is also inadequate. So, as the blending of insurance and investment in a single product leads to suboptimal returns and is not giving us the desirable outcome we want, we are going to explore an alternative strategy where we can separately invest in insurance from investment and see whether it can give us better liquidity and better returns just for a comparative analysis. So consider purchasing a pure term life insurance policy with a sum assured of 15 lakhs at an annual premium of 9,700 rupees. With a policy term and a premium payment duration of 20 years, this leaves us with 1,40,000 rupees 300 annually available for investment. This amount can be allocated based on your risk appetite. So if you want to take a low risk approach, then investing in a debt instrument like the Public Provident Fund PPF will result in a maturity value of 62.27 lakhs with an IRR of 6.53%. Notably, this is comparable to the returns in the 8% scenario of the Aviva policy, despite PPF being a safer debt instrument. And if you want to take a high risk approach, you can allocate your funds to an equity oriented instrument like the Equity Linked Savings Scheme ELSS fund, which will yield you a pre-tax maturity value of 1.13 crores. So after accounting for capital gains tax, the post-tax maturity value is 1.02 crores with an IRR of 10.68%. So ELSS being market linked delivers significantly higher risk adjusted return along with the added benefit of liquidity and unrestricted withdrawal. When compared to Aviva policy, the policy in contrast lacks both the flexibility and the ability ability to deliver superior risk adjusted return, making it less effective than the alternative strategy of separating insurance and investment. So, what is the final verdict on our analysis? Is the Aviva signature investment plan platinum worth investing or not? So, this plan is marketed as a dual purpose solution offering security through the sum assured and growth via the fund value to support your family. However, a closer evaluation reveals significant shortcomings due to its low potential return. The high charges associated with this ULIP severely impacts its performance, resulting in subpar returns and limiting its ability to accumulate wealth, and it also has a high agent commission. Furthermore, the plan's inadequate sum assured reduces its appeal. So, combining insurance and investment in a single product compromises the overall efficiency of the Aviva signature investment plan platinum. So, a more effective strategy would be to secure your family's future with a pure term life insurance policy which provides substantial coverage at an affordable premium. To achieve your financial goals, consider investing separately in options that align with your risk tolerance and market time horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.